Oil and gas companies do not have market power. They are pure price takers on a global commodities.
Gas is a completely different story than oil. As the WTI forward curve has moved up, Henry Hub has moved in an opposite direction. One on the gas side is completely unhedged. The two-way collar was by far the most popular hedge instrument. It's probably more going to be the price floors.
Welcome to Top of the Barrel, a podcast by Novi Labs. Each episode, we're going to be digging through a different research report that we published recently as a way of essentially bringing research that you may not always have access to out to you. So before we jump into our hedging podcast today, I'm going to let two of the people that work on my team introduce themselves, Brett and Mike, and I'll let you guys take it from here. So Brett, why don't you start?
Yeah, my name's Brett St. Clair. Started my career in the field in the oil and gas business. Got a degree in mechanical engineering and then went to work for Baker Hughes, first as an MWD hand and then as a directional driller for 6 years in the early days of the unconventional boom, mostly through the Mid-Con and the Barnett, Anadarko, Arkoma, Fayetteville basins. Spent some time on the North Slope of Alaska and then spent some time in Saudi Arabia. Went back to business school and then joined a small startup private equity firm called Kimmeridge Energy as it spun out of AllianceBernstein and spent 10 years on the private equity side, investing in emerging unconventional plays and operating those assets. Joined Novi Labs at the beginning of 2025 to join Brandon's intelligence team. And now I sit as a research director on that team, helping to flow our inventory models through companies and through the macro environment to see how that's going to impact the U.S. lower 48 unconventional business.
And Brett, you were famously working, I think, in the Michigan basin during the 2008 financial crisis.
I was drilling underbalanced wells in shallow northern Michigan in 2008 when we got the call that we need to be off location by the end of the day because we can't pay you for tomorrow.
You'll leave that out of your resume.
Yeah.
Okay, Mike, up to you.
Yeah, Mike Steinball, prior to Novi, actually began my career right out of undergrad in politics, state politics in Austin. Ended up on a Texas Railroad campaign, and then at the RRC, which was my introduction to oil and gas, decided to then go get a full-time MBA, wound up at Wood Mackenzie, and then into industry at Tellurian, and then Post Oak Minerals, just before joining Novi, where I now sit on the corporate research team with Brett.
Thanks, guys. So maybe before we kick off here, for some context, for very obvious reasons or reasons that will become obvious in the next 10 to 15 minutes, we put out two hedging pieces in the last couple of weeks. The first was on oil, and obviously very topical with what was happening overseas. But gas kind of sneakily changed a lot over that same period. So before we go into the specifics, something that might be useful for the audience, can be a mixed crowd. Brett, why don't you walk us through the point of hedging, I guess, both philosophically and then zoom into some of the words that you might hear or read in the hedging piece.
Yeah. So to understand why an oil and gas company, like specifically a producer, would hedge, you kind of got to understand what we're doing. Um, Oil and gas companies do not have market power. They are pure price takers on a global commodities, for which they don't have much impact on total market share, even the largest companies. The price of oil or gas is cyclical and trends around the marginal cost of supply. So sometimes that cost is going to be high, sometimes that's going to be low. As an operator, you have to make commitments, long-term commitments often, in order to run your business. If I'm going to lease a bunch of acreage in the Permian, I might have continuous drilling obligations if I want to hold those leases. If I want to get a good price on a rig or a frac crew, I might need to commit to that rig or frac crew for multiple years. If I want to get pipeline infrastructure built, I need to commit volumes to that pipeline for long term. that is take or pay. If I don't deliver volumes into that pipe, I have to pay for that space anyways. And if I want to finance part of my operation with debt, banks are going to want to make sure that I can service those debt payments so that I lock in the price I'm going to receive for some of the volumes I produce. So there's legit reasons why an operator would want to hedge or sell its production in future periods today. Now, why wouldn't you hedge everything you produce? Well, what an oil and gas company offers an investor is just a piece of its portfolio. The investors typically don't put 100% of their portfolio in oil and gas or commodity names. Energy is the input into the rest of the economy. And so as energy prices go up, this can hurt margins for consumers of energy that produce all the other goods and services in the economy. So if you're a diversified investor and rising energy input costs are negative to your portfolio, you want to diversify your portfolio to own some of those energy names. That way, the upside you get from the energy names, outperformance in those rising price environments, offsets some of the hit to the rest of your portfolio that you might be exposed to. And so, as an operator of an oil and gas company, if I hedge all my volumes, I kind of lose my whole reason for being in my investor's portfolio. They need to get upside in rising prices to offset any negative hits to the rest of their portfolio. So we're walking a fine line in the amount that an operator might hedge between needing to be able to have enough visibility on price so that I can effectively plan and operate my business versus needing to retain enough exposure to the commodity price to serve my purpose in an investor's portfolio. So this is why we hedge. Now,
But
Mike's going to
Brandon,
go.
I'm gonna
Yep.
interject there. So it sounds like maybe 30,000 foot view. Well, I was at GasCon speaking maybe a month or two ago, and I was up on stage with someone from Conoco, and he kind of made a funny quip that he said, "We believe that if you're an oil and gas investor, you want exposure to the prices of oil and gas." But I think the 30,000 foot view answer to what you just said is it's not an illogical or logical thing to do. It's a question of obligations.
Yep.
It's probably the one liner, right? So, but yeah, pass it back to you.
Yeah. How much do you need that future locked in today in order to plan? Right. And so you want
Yeah.
to keep your obligations low as a company. You want to retain optionality. You want to retain flexibility in any business. You want to
Mhm.
keep your obligations low. However, having no obligations is going to just raise your price of business. You're going to
Y-
be paying spot
Yeah.
market prices. You're going to be the marginal buyer of every rig, every frac crew. And
Right.
so you're going to
Right.
be paying the highest prices. You're not going to
Yes.
get good firm transport on pipelines. So you need to be able to make commitments.
Yeah.
Um,
So so switching it gears, I guess, from the philosophical to the nitty gritty here. If you are a geo or an engineer and you maybe don't have as much exposure to the banking side, what's a swap? What's a two-way caller? What's a three-way caller?
Yeah. So Mike's going to go into how these instruments are being used in operators' portfolios today. But just to give you a little background on some of the words you're going to hear on these contracts. So we looked at four main ways that companies are hedging: swaps, two-way callers, three-way callers, and puts. So three of these are going to be costless to the operator, and one of these the operator is going to pay for. When you look at a swap, you're effectively going to a bank and you just say, "We're gonna we're gonna price a swap for a certain amount of volume for a certain price." So let's say we swap at $65. I'm not paying you anything today, bank, but we are going to settle this swap over some time frame for the difference between 65 and whatever the price is for a certain amount of volume.
So
And
they're
so
just
if I
getting the spread between some fixed price.
yeah,
And if the bank's right, the bank will get more than they thought they were going to. And if the operator's right, it'll go the other way.
yeah. So if I swap, 100,000 barrels a day at $65 a barrel, NYMEX WTI with a bank, and the price goes to 70, I pay the bank $5 times 100,000 barrels a day. If
Right.
the
So you
price goes to
maybe to
60,
really simplify this, you are quite literally swapping the price that you thought you were going to get to the price that you actually got. That's what gets swapped.
Yeah.
Yeah.
And,
Yeah.
and the key thing is like you still actually sell your physical barrels
Hmm.
for the actual price in the market.
Right.
Your deal with the bank is separate. And so
Right.
if the price goes to 70, in this case where you have a swap at 65 and the price goes to 70, I'm selling physical barrels for 70,
Right.
and then I'm paying $5 a barrel to the bank because I'm on the wrong side of
Right.
the 65 to 70 spread.
Right. Okay. And then moving to callers.
And so as we go into collars, there's a couple ways we'll play it, two-way and three-way. So whereas a swap, you lock in a fixed price, a collar, you want a range. And so you do this through the options market. So the way we do a two-way collar is I'm going to buy and sell options to get a spread. So I'm going to purchase a put option, which means if the price goes below the strike price of the option, I'm receiving the difference. That's going to cost me an option premium. The way I pay for that option premium is I write or sell a call option, meaning if the price goes above the strike price of the call option, I'm on the hook to pay the person on the other side of that. So
Right.
so those premiums offset each other. How much I receive for writing the call is what I pay to purchase the put. Now, the nuances of the option market are going to determine how much premium I pay and how much premium I receive for that put and call. So, how wide that spread is on that collar, how skewed to one side or the other of the spot price that may be, is going to be determined by many things going through the option market that are way above our pay grade here.
Yeah.
So that will give me a range where I'm exposed to the price floating in the range between the strike price of the put and the strike price of the call. And on the outsides of those, I'm going to pay or be paid, um, which cancel each other out because I'm on both sides of those options.
Right. And so maybe again, just to really simplify this, you're selling anything above and beyond the ceiling, but you're protecting yourself from anything below and beyond the floor.
That's right.
Um, and then
That's
really
right.
quickly, just to top this up with a three-way caller, my understanding is you essentially are you sell anything above and beyond the ceiling, and then you also sell some pie in the sky number to try and make it, and I touched on this earlier, costless. Do you want to maybe just walk through those dynamics?
Yeah. Well, what you want to do on a three-way collar is maybe you want a higher ceiling from your two-way collars. You think that range is too tight. You think that prices could move higher than that. So you're actually taking a view here. So you want a higher ceiling. If you want a higher ceiling, you're not going to receive as much premium for writing that call up there as you paid for your put. So what you do is you
Right.
write another put, you sell another put below the strike price, further out of the money than the put you've purchased. And so that returns your exposure. Whereas in the two-way collar, you had perfectly offsetting exposure. So you didn't receive anything above the ceiling or pay anything below the put. Now you've raised your ceiling so you can get higher prices in an upside scenario, but you are fully exposed below what we call the subfloor, the
Right.
further out of the money put that you sold. And so now you're locked into a price range between the floor and the ceiling, between the call you sold and the put you purchased. And then there's a further range below that put you purchased where you don't have any exposure. And then below your subfloor, you have exposure again. So in a
Right.
three-way collar, you benefit from a higher ceiling, but you are now exposed to deep out of the money low prices.
Right. So you've sold a kind of pie in the sky scenario to the downside, and
Yeah.
you are exposed to that if that plays out. That
Yeah.
makes sense. Okay. Then, that was a good educational piece.
The
I
the
want to get
final
into some. Oh yeah, go ahead.
one more piece, Brandon, that we touch on,
Mhm.
and a couple of operators or maybe only one operator does this, but this is just purchasing puts. A put option, you pay a premium for it, and you protect yourself below
Mhm.
below the strike
Right.
price of that put.
Simple.
This this is
Simple
simply
floor. Yeah.
like basically exactly like buying insurance.
Right.
Um, you pay a premium every month for insurance. Any downside cases, they pay for it. If you buy a put at strike price of 50, anything below 50, um, you're not exposed to, but
Right.
you pay for that. You don't offset it by writing a call. So you retain full upside exposure. You protect only your downside, but you pay a premium for that. It's very like insurance.
Okay. That makes sense. Mike, I want to turn to you. We've probably put you to sleep here, but I want to get into some actual names on the oil side, high level. Walk us through what was the relative change in price received versus spot markets, and what operators were actually hedged at or had kind of sold their ceiling at on the oil side.
Sure. So looking at the oil focused peer group, I mean, of all the possibilities that Brett laid out on how to hedge, I mean, it is across the board wildly different. With some
Mhm.
operators even choosing to go completely unhedged, giving themselves maximum upside. These operators that were fully unhedged were ones such as like Apache Corporation, ConocoPhillips, EOG, and Magnolia. They were really, as Brett kind of laid out, that investor thesis of if you are an oil and gas upstream operator, giving your shareholders maximum upside, those companies are giving their investors maximum upside. On the
Okay.
hedging side, some operators only chose one type of hedging instrument, while others employed multiple, and it was a combination. Kind of looking just at the most simple, it's swaps. Really, the big three that locked in the most swap volumes were Permian Resources, SM, and Crescent.
Mhm.
Now, kind of looking across every operator in the oil focused peer group who locked in swaps, that average 2026 dollar per barrel swap price was very close to one another. I mean,
Okay.
everything is between 62 and $66 a barrel. And when you
Right.
look at that number, you think, wow, that's significantly lower than where that 2026 forward curve is currently trading.
Yeah.
However, when these swaps were likely enacted sometime in the previous year in 2025, that swap price was likely at or even above where the 26 forward curve was trading. So, what a difference a quarter makes when examining, hedge books.
Yeah.
Um, Kind of moving on from swaps into collars. Yeah, there were both two-way and three-way collars employed by the peer group. Again,
Mhm.
with the collar, you're going to have a little bit higher, ceiling price than just a pure swap. And then the three way is an even more bullish way to hedge than the two way, although riskier as you have that subfloor that could come into play.
Yeah.
Um, just in general, macro theme on the collars. I mean, given where their forward curve is trading currently, these ceilings are going to have much more of a focus than the floors. And interestingly, like when you look at that, Q4 numbers that were reported about, you know, 2 or 3 months ago, we were seeing, ceiling prices of $67, $68, 70, maybe 71. Cord had a three-way collar that held a ceiling of $76.55. Um, Fang just reported their earnings and they're showing a ceiling price of $115. So quite a significant jump up in just the types of or
Right.
the ranges that are being offered in the market. Um,
So maybe from there, Mike, you know, the hedging peer groups are there. Which names stood out as having either full or close to full exposure to the spot price and the forward curve on the oil
yeah,
side?
so yeah, we rattled off earlier like Apache, Conoco, EOG, Magnolia, but I do want to highlight Fang's strategy. Brett said they
Mhm.
carried puts,
Mhm.
and they are their strategy of carrying puts is essentially you're completely exposed to the top.
Right.
Just want to highlight kind of we think this is a very you say optimal way if you have the flexibility that they're such a large operator, they have liquidity, they not like a smaller operator could not enact this type of
Right.
FANG strategy of
Right. Right.
carrying puts to protect their downside. So this is kind of the the bigger operator showing what they can do, and we think
Right.
this is probably the most prudent way to hedge of retaining complete exposure while carrying puts.
Makes sense. So, before we wrap up here, I do want to touch on gas briefly. Um, my understanding has been that oil obviously spiked in the previous months, gas has come down. The focus then is not on the ceiling as it had been with oil, but rather the floor. So, maybe two questions I'll pose to you. One is, um, any names that maybe stood out to you on the gas side? And I know at the end of the day, obviously, we're not a brokerage. We don't recommend equities, but I'm still curious to see who had a, I suppose, healthy hedging strategy on the gas side. And then after that, this is a final note. I am curious about this being the first quarter that EOG's JKM linked contracts are supposed to kick in. So, just given that you're a resident LNG expert, I thought I'd pose both of those to you.
Yeah, sure. So gas is a completely different story than oil. As the WTI forward curve has moved up, Henry Hub has moved in an opposite direction. A lot of things at play there, with one kind of the big obvious one, um, likely more associated gas in the marketplace when oil is so high. As that Henry Hub forward curve has moved down. No one on the gas side is completely unhedged. So
Mhm.
everyone in the large the public gas focused peer group has some sort of hedges on the book. Also, not as diverse of as far as the hedging instruments that are used. The two-way collar was by far the most popular hedging
Right.
instrument
Okay.
with expand. Um, with expand even showing 4.65 bcf a day of a two-way collar position. I mean, that is
Okay.
just
Yeah.
massive. That expand hedging position is larger than pretty much the production base of almost every other gas focused operator. Kind of all of the names, uh EQT I think is probably the most interesting, is just they have left themselves the most upside. Only, about 27% of their 26 forecasted production base is hedged, and they did that through a two-way collar with a price floor of 383. So kind of
Okay.
that when you're comparing their price floor on their two-way collar to the rest of their peer group, they had a higher price floor. So kind of opposite from, as you said, from the oil focused peer group, the floors or on the oil side, ceilings are going to come into focus. Where we think, especially in Q2, Q3, for the gas, it's probably more going to be the price floors.
Yeah.
And then kind of moving into what you noted, something we just wanted to highlight is the international price linked contract. Yeah, that's something that everyone on the gas side has been striving for, and actually being able to get it is quite difficult.
Yeah.
Um, EOG does have a it is the disclosed terms were at EOG's election.
Mhm.
They could price link to either the JKM or Henry Hub index. And kind of some terms we've gathered on this contract are it is an international natural gas sales agreement for 420,000 MMBtu a day for 15 years.
Okay.
That the contract does not become active until the completion of Cheniere's Corpus Christi Stage 3 expansion, specifically citing trains 1, 4, and 5. Now, as of last month or 2 months ago, all three of those cited trains are now operational. So we do believe this contract is in full service.
Right.
And then due to just the, kind of we'll say geopolitical uncertainty in the recent month, that spread between JKM and Henry Hub is increased by quite a bit. So kind of this contract, would read as the assuming EOG would elect to take the JKM price index, it would be that spread between the two, and then there would be a transport cost and liquefaction fee also taken out of that spread.
Right.
The kind of exact terms are not disclosed to the
Yep.
public, but just kind of based on the current macro factors, this EOG international contract will likely hold a pretty high realized value.
Well, I think that the back of the napkin math we did was essentially it should at a minimum shake out to something around 2.5 times Henry Hub is what they'll receive post liquefaction and transport fees on something to the effect of 10-ish% of their production, I think, on the gas side. But we will find out today. I believe EOG's earnings are this afternoon. So it's very topical. Wanted to thank you both for your time today. uh, Stuff that's coming down the pipe and plausible future podcast topics. We've got a really cool NGL forecasting piece in the Permian, as well as some work we're doing on the um, negative Waha price at which drilling for oil no longer makes sense. So that's what's coming down the pipe. And until then, yeah, we'll close it off there. Thanks, guys.
Thanks,
Yeah,
guys.
thanks, Brendan.